In December 2015, the Federal Reserve raised interest rates by 1/4 point. Going forward into 2016, we've seen considerable market volatility, and it is expected that the Federal Reserve will raise interest rates again another 1/4 point. Joining me now to discuss this and other issues is Tracey Manzi, VP of Investments with Cammack Retirement Group. Tracey, thanks for joining us on the show today.
Thanks for having me, Jeff.
So we've had a rising rate environment, I guess 1/4 point, and certainly this has had to play into the discussions you're having with many of your plan sponsors.
Right. So as you so eloquently put, the Fed raised interest rates for 25 basis points last month. So this is really the first time in almost the last decade that the Fed has raised interest rates, certainly first time since the financial crisis of 2007. And what we've seen initially is the market didn't pay too much attention to the rate hike as it was widely anticipated. But what we've seen throughout the course of the end of 2015 and certainly coming into 2016, the markets have gotten increasingly more volatile. Now the Fed is expected, based upon what projections that they put out at their last FOMC meeting, to raise interest rates 4 times in 2016, which basically means they'll be skipping a meeting and going every other meeting. But certainly the risks are to the downside there, given the kind of volatility that we've seen at the start of the year.
Tracey, I know that in your career as a portfolio manager, you've dealt with all different types of plans, defined benefit plans, endowments, foundations. Defined contribution plans are a little different in that they're participant directed. And so it's designing an investment menu that really makes sense for the average participant.
Mm-hmm.
And given this rate environment, the volatility we've experienced, what trends are you seeing in terms of the fixed income marketplace in particular as it relates to the investments that you're advising clients to include in their plans?
So basically what we're seeing with plan sponsors is kind of re-implementing or thinking about the bond or the fixed income allocations across their plan design. And traditionally when we've worked with plan sponsors, or historically plan sponsors have had very few or limited options in the fixed income space. They've tended to have a stable value or a guaranteed fixed interest type of account, maybe a money market, and then your core bond holding. What we've seen, or increasingly, certainly moving into this rising rate environment, as people have talked about it ad infinitum for the last couple of years, is that we're seeing a broadening of fixed income options added to a plan menu. So for example, when we're going in and streamlining an array and talking to the different plan sponsors about the type of exposures they might have in the fixed income space, we're typically adding options, investment options, things like active management in the core space, perhaps a high yield fund, a world bond strategy, and to a lesser extent, but some plan sponsors are comfortable with emerging markets as an asset class. And almost invariably, as an inflation hedge asset, you do see TIPS as an asset class added in the fixed income space.
Now, many plan sponsors have, or not many, but some plan sponsors may be considering passive investments in their retirement program, and they may be thinking about it potentially in their fixed income array, a portion of their array. But thoughts around that? I mean, does it make sense to go passive in a fixed income portion of your investment menu?
We typically include a passive core bond option as part of the overall array, really to structure the investments so that if a participant wanted to choose an all passive lineup, that they have the option of that low fee, just take what the market gives you type of investment. But when you look across the different asset classes or the different subsectors in the fixed income space, what you really see is that active management pays. So the majority, it's probably closer to 60+% of the managers in the core fixed income space that are active managers actually outperform the benchmark. So yes, you're paying a higher fee, but you're getting compensated for that extra fee that you're paying in terms of alpha that's getting produced.
Now, the core menu is important, but target date funds, we just had Jen Stevens on. That's an important component to a retirement plan. We've been talking about the Pension Protection Act, the importance of the qualified default investment alternative. within the target date fund, there's a fixed income portion or allocation. And so it's critical when you're working with plan sponsors, when Cammack is working with plan sponsors, you're not only considering the core array, but now you're drilling down within the target date fund sleeve.
Right, and invariably when you're in a target date fund, what happens is that glide path or that equity exposure dynamically adjusts till you get towards the age of retirement, which is 65. And that increasingly, that fixed income exposure plays a bigger and bigger role as you get closer to retirement. And when we're working with plan sponsors and we're looking at the different target date strategies, we're not just looking at the equity exposure, we're also looking at what all of the breadth of instruments that they use or products that they use in the fixed income space to help the end investor in that target date. And a lot of the target date series that we're using don't just have that core bond exposure, they have exposure to what we call the extended asset classes. Like I was saying earlier, high yield, some have bank loans, emerging markets, floating rate notes tend to be popular in some of the target date funds.
Now, many managers assume that there was an interest rate environment, so therefore they may have baked in those assumptions into their asset allocations. And I think that's a fairly true statement. But still, it's important and incumbent upon the fiduciary to review and evaluate these products at a minimum on an annual basis. I mean, they should really be talking about it quarter by quarter, and I think you do this with your clients, we do this with our clients. But don't you think that on a minimum, it's an annual basis, you're looking at that level of detail? And given the change in the interest rate environment, around now is probably the best time to do that.
Yes, certainly. Just as a matter of process on the investment team, we're looking on a quarter-by-quarter basis at the different sectors of the market, and certainly in the target date series, we're reviewing them on an annual basis. What changes are the different managers making in the underlying products that they have or sub-asset classes that they have in their target date strategies.
Changing gears a little bit, you talked about fixed funds, and I'd be remiss if I didn't bring that up. Certainly, it's always a fun topic. Looking at guaranteed or stable value funds, that's a critical part of your and the investment team's job. Are you seeing a lot of dramatic changes there in terms of credit quality as it relates to this interest rate rise, the volatility we're seeing in the current market environment in general?
For all intents and purposes, with those guaranteed products or stable value products, they tend to be invested in high quality assets. Certainly, a reasonable portion of the allocation will be to the credit markets, which are not immune to some of the volatility that we're seeing, but they predominantly won't be invested in sort of the higher risk strategies like some of the credits that are being affected by what's going on in oil prices or high yield bonds. They're much more of a stable, steady as you go type of investment vehicle that's not going to have the sort of whims and starts of the market given the volatility.
So but when you're doing your analysis, you're looking at the portfolio of the investment. So, and it may be a fixed income manager, may not be, maybe a general account. But then you also have to look at the creditworthiness of the organization providing the guarantee, or organizations, I should say, because there are multi-wrap managers.
Right.
That's obviously a key part of due diligence, manager due diligence for you and the team.
That's right. And we're certainly looking at that on a quarterly basis, making sure that there's no deteriorations in both the underlying investments themselves, and the overall credit quality of the investments, and certainly with the stable value accounts, they'll have regulations that will keep them in a higher quality, not necessarily treasury only, but a higher quality type bias. But also within the wrap providers, what capacity do they have to take on that risk? Is it a single wrap in the case of kind of the TIA crafts of the world? Or is it a multi-vendor solution, which we have in a lot of the sort of kind of more stable value, more floating with what's going on in the marketplace?
Tracey, Manzi, very insightful comments, and looking forward to having you back on the show a little bit later on in the year. Thanks for joining us.
Thank you.